Drama is back in focus today with the NASDAQ selling off, but honestly, no matter when you watch these videos, the market's either going to be up or down. What matters more is what's going on with tariffs, what is the latest update, and what's going on with that Atlanta Fed GDP measure. Because the last GDP measure we got from the Atlanta Fed was in that negative 2.4% range. However, the Atlanta Fed provided a note on LinkedIn of all places suggesting that the adjusted Atlanta Fed model was probably closer to 0.4%. But even 0.4% is a substantial write-down from where we had been previously, which was well over 2.5% to even 3% towards the early portion of the year. In fact, you could see that right here. Well, the Atlanta Fed, after the durable data release this morning, came out with a new update. And the current update released today, March 26th, is that GDP is growing at negative 1.8%. However, the Atlanta Fed is now providing a gold-adjusted GDP now report, and they provide why they are providing all of these updates. If you really care to read all their formulas and all this junk over here, they had a really good LinkedIn summary of this, but basically, when they remove, gold and sort of adjust for these rapid changes in gold imports and exports that are going on, you actually get a GDP now forecast, which probably more closely aligns with actual GDP of around 0.2%. Well, I don't know about you, but if our GDP is only growing at 0.2%, that's pretty damn miserable. That is very low. And I'll tell you why it's very bad. In 2007, we were told that GDP was growing at 0.7%. Everything was fine. But what ended up happening is about a year later, they revised GDP down over 1 percentage point, and you actually had negative GDP, and oh my gosh, you were actually in a recession the whole time. So this makes it possible that we already are in a recession. We just don't recognize it yet. Now you have people like Cathie Wood say it's just a rolling recession, but this GDP estimate, even gold adjusted, is a little bit of a slap in the face to some of the uncertainties that are essentially being caused, at least in some part. I'm not saying Trump is entirely responsible, but at least in some part being caused by this Trump tariff uncertainty. We saw that actually in the durable data this morning, and there's some nuance to the data. And so I want to explain some of that data a little bit because it does get complicated and it's worth just breaking it down. So today was the first day we actually had a bit of a real data hit. So far, we've had hits because of soft data, but now we're actually starting to have some real hard data hits. And how are we seeing it? Well, we're seeing it when you actually look very closely at the data. First, this morning durables data, like durable goods like washing machines and cars, even X cars, that actually beat for the preliminary read for February. So in other words, people still bought more of these goods in February than economists expected. Economists expected, negative 1%. Actually, I think it was negative 0.1% or 1%. Either way, they expected a negative read, and we ended up getting a positive 0.9% read. So obviously a little bit better on the durables data. Okay, so where's the bad news in this, Kevin? Well, it's capital good orders. See, durables and shipments are things that have already either been paid for or already being bought. Orders are a little interesting because orders are something that could still be canceled, or it could be a sort of more of a future read. In other words, there's a delay between a capital goods order and a capital goods shipment, for example. Shipments beat, also 0.9 versus 0.2 expected. So you're getting a beat on shipments for February. But what about orders? A little bit more of a leading hard data read. Well, capital good orders missed. They came in at negative 0.3 versus 0.2% expected. So all these numbers can get really confusing, but let's put a little bottom line on that. What's happening is businesses are actually starting to say, you know what, let's wait. Now, I've warned about this before. I've warned, and it's my unpopular opinion, that companies are going to substantially delay their massive Trump knee-bending capital expenditures because they can be truthful and say they're going to invest all this money over the next 4 years, but then they could also be a little sly about that or slick about it and say, and we'll start that project in 2 years when we're in the deep, dark recession and it's cheaper for us to build that factory then. Or we don't build the factory at all and we U-turn on it without committing to anything up front other than, getting the pleasure of Donald Trump exempting you from tariffs because you're like, $500 billion coming your way, master. And then when the circumstances change, you're like, just kidding. We're in a recession. We ain't doing that. In which case, Donald Trump would have way less leverage to punish you back anyway, because the economy would be weaker and he sort of needs you anyway. Hey, quick house hack pitch. Here we go. Minute 45, then back to the data. $171,000 of wedge value we made. Didn't pay a dime of taxes on it because we bought a house for $507,000 that's worth about $760,000 right now, and it looked like nasty. Who's going to live in that? No soul is going to live in this. It's disgusting. It's like rot and feces and nasty. It's disgusting. And the house hack comes along and makes it beautiful again. And just remodels and renovates everything. So we get paid money for that. And the more people invest in our 5% bond, which we just doubled the people investing in our bond over the last week, which is crazy. I think people are diversifying from the stock market. You can be a non-accredited investor now too. You get a 5% yield. You get upside. If our valuation goes up, you get 100% of the upside. You get 5% per year, and we buy, fix, build, and manage the real estate for you. And we do it in a transparent manner. All of the properties are listed. Like, that's our building. That's our house. Like, these are our properties. You can see them all over at househack.com. It's kind of cool. So I encourage you to check that out, househack.com. At least think about it. Like, people ask me, like, Kevin, well, what's the deadline to invest? We're not trying to pressure anybody to invest right now. If it's good for you as a diversifier, do it. That's your personal decision. Read all the information about it, the circulars and pre-PMs or whatever. But we see it as the sooner you invest, the sooner you A, diversify, and B, get a 5% yield, which is kind of cool because you get both. The upside of private equity stock, downside protection, and the yield. But I mean, really, if you think about it, sum you up on my unpopular opinion video that I made, why would you build a factory in the United States only to return to free trade at some point in the future, and then all of a sudden you were absolutely uncompetitive? You were probably the most uncompetitive factory that you could have possibly built. You really need government grants to make you competitive again. Otherwise, it won't be a sustainable U.S. worker job. It'll temporarily be sustainable, but then guess what happens? You end up going, like, that company goes bankrupt, or that factory or facility or whatever it is gets shut down because you just end up outsourcing back to a globalist economy again. That was my opinion. But then I read an Economist piece this morning, and the piece almost reads like I wrote it, which is a problem because I don't want to sound biased in this. But I just want you to see it yourself. So here it is. The Economist, this is a screenshot from it. The chill that extends beyond the manufacturing industry. Okay, so now this is interesting. The chill that extends beyond the manufacturing industry. Okay. David French of the National Retail Foundation or Federation notes his members would like to nail down their sourcing arrangements. Can they rely on production networks that run through Mexico, or factories in Southeast Asia a safer bet? Purchasing managers do not want to make rash moves until the dust settles on the new tariff landscape, whatever it may be, and the uncertainty is delaying other investment decisions as well. Tariffs on building materials and consumer goods add uncertainty to opening new store, Mr. French says. But companies know how to flatter the president. Many of their announcements concerning spending plans were already in train before Donald Trump took office, The Economist here says. Moreover, for every announced deal, others are languishing. Recent surveys from the Federal Reserve branches in New York and Philadelphia registered sharp declines in manufacturers' outlook for the economy over the next year and a half. This is basically where they're saying, while Trump is announcing all of these deals, a lot of them may have already been in the works anyway. We're not talking about all the deals that are getting canceled. Like, in a moment, we're going to talk about how Microsoft is canceling even more data centers than the first time we heard the story. So now this is really interesting because The Economist is now doubling down on this argument, and they just wrote this piece, but this unpopular opinion that I made a few weeks ago, it's starting to sound very familiar. It's starting to sound like I wrote this. I didn't, I swear. But it sort of makes it seem clear that other companies and economists are seeing the same thing, that, yeah, why would we invest right now? Why don't we just wait? And that could probably reiterate why these tariffs are so damaging. You know, Bloomberg Intelligence actually had a really interesting piece on software this morning, where they suggested that, only a fraction of the federal government's software spending or the federal government software spending only represents a fraction of all software spending in the United States. But when you lump all of the downstream effects together of what the government is responsible for, like one department using software to then allocate funding to universities who then have their own software, you could potentially argue that up to 40% of the app software market is exposed to government cuts, which is really bad for software businesses, because now you're talking about negative licensing seats, negative growth on software companies that already have pretty rich valuations. Not great. Donald Trump also talked about auto tariffs coming as soon as today, copper tariffs coming, potentially fewer exceptions now than expected. I mean, Trump is kind of the definition of an actual flip-flopper. You know, one day it's, April 2nd is going to be Liberation Day. We're going to have the largest tariffs we've ever seen. The next day is, there are going to be a lot of exceptions. Some countries won't have any tariffs at all, and a lot of companies won't have any tariffs at all. Oh, by the way, look at Hyundai. They're announcing a factory, and yay, they're going to be exempt from tariffs. Good boy, Hyundai. And then today it's, we're actually going to have a lot fewer exceptions than we expected. So guess what that means? Oh, stock market down. Oh, wow. Even just in the time that I've been yapping here, it's falling even more. 1.96% on the Qs. Tesla down, 6.6%. This morning we were playing with these lines a little bit on the Alpha report. I suggested if we were to go down at the open, we would go down to 489 in the Alpha report. It's exactly what happened. Now, we broke that line as well, and now we're just off a cliff. We'll have to see where the next stop here is. I didn't think it would be a full 3% to get us down to 479, but boy, now it feels like we're bleeding to that direction. We're down 2%. I don't know. And then on Tesla, I thought, we would end up coming hit 274 in a down scenario, which we did, and then got rejected by it. As we're getting rejected by it, we ended up losing even the 271 soft line, which puts 260 back in play for Tesla. A little challenging here. But anyway, that's just some of the TA that we talk about in the course member live streams or the Alpha report, which remember you can get those over at meekevin.com. So now all of a sudden you're seeing some of the hard data start to roll over. Remember, a lot of this is still February data. The fact that we're seeing orders weakening in the face of more of these uncertainties is problematic. Now, the economists suggest we only have about a 25% risk of recession, that we're not in a recession right now. Again, people dispute whether or not we're in a recession right now or not. But it's really clear that growth is slowing. You've even got Fed member from, I think it's the St. Louis Fed, St. Louis, isn't that? Yeah, no, St. Louis. They were St. Louis. Growth does appear to have slowed, probably because businesses and people are worried about, tariff impact. And Kashgari reiterated that this morning as well. So a lot of Fed speak, this talk about tariffs are a threat that grows the longer it affects confidence. So in other words, if we just U-turned on all tariffs right now, maybe we could go back up. But if we keep doing this, no tariffs, lots of tariffs, the most tariffs ever, fewer tariffs, more tariffs, well, all you're really doing is just destroying GDP growth. Because everybody's like, let's just wait. People aren't going to buy machinery. I mean, like, if I was a business owner right now thinking, okay, I'm gonna sit here and let's say I'm a kitchen carpenter, okay, because that's what my father was, and a kitchen designer, and I need to decide, do I want to buy a new CNC for my warehouse? I probably wouldn't make that purchasing decision right now. Say, well, I'll decide in 6 months, and I could still take the tax deduction this year, as long as I do it before December 31st. Why would I make that decision in March? I'll just wait. That doesn't mean you're bearish on your business. It just means you're like, we'll just make do for a little while longer. But if everybody starts doing that, That's why you get the Atlanta Fed GDP so negative and how dangerous it is, how rapidly you could really screw up the economy. Now, of course, the Trump administration suggests that this is just a detox period. Fine. But I'll tell you, if we go into a deep, dirty recession, you're going to have... Detox is going to feel like a depression because so many people will lose their jobs. So far, though, no big layoffs yet. Hopefully that keeps going. Maybe that's because corporate balance sheets are so strong. And they are. The biggest companies are the most profitable and most cash rich compared to any time in history. Which is good because it creates an insulative blanket. The question is, when do we pierce that insulative blanket? And consider that, 45%? Somewhere around 45% of jobs in the United States come from small businesses. Now, Bloomberg suggests that, the sales recession's already been priced into the Russell 2000 small caps. Oh, okay. Now we're going to call it a sales recession, not an actual recession. It's not an actual recession. It's just a sales recession. Whatever. I don't know if I buy that. So I'm a little concerned about that. And so I think it was Barclays this morning that said we're kind of like in a Rorschach economy right now, where if you hold up, Rorschach test, like the ink blots, they hold it up and they're like, what do you see? One person's like, I see a dog. One person's like, I see a house and $1 million of cash. People are like, all right, well, I thought we were on animals, but I guess we're talking about something totally different. So Barclays says this because there's so much data for both bulls and bears. This morning in the Alpha report, I actually called this market the checkerboard market, where it's sort of like there's so much white and black, or red and white, or whatever colors you want to use. It's sort of like, there's data all over the freaking place yet. You just don't have a clear board. So we don't know. We don't know who's winning right now. Myself, though, I'll give you an update on the bull-bear scale. Technically, by the way, that is the bear-bull scale. And so the bear-bull scale right now, for me, sits at about 2.9. Now, you have to be careful because there are people that just don't understand nuance in the comments. And they're like, oh, one day Kevin's bullish, one day Kevin's bearish. That's not true. It's not a light switch. And I try to be, like, the reason I created the bear-bull scale and I try to be so transparent with everything that I'm responding to is because there's so much nuance involved. I've been sitting 2.5 for quite a while now, probably a couple months here, since probably about mid-Feb. I turned under 5, so bearish back, in June of last year. It was more like July of last year, mid-July of last year. We went under 5, so went more bearish. And then we've been bouncing around this sort of like 2.5 to 4.5% number range based on data. So last week I'm 2.5. Then we get really good data on Monday. We actually did get good data on Monday and a softening of the tariffs that we heard about on Friday. And I'm like, okay, maybe we're 3.2. Then we get some mixed data again this morning. I'm like, we are still bobbing around that 3 level, but I'm sitting around a 2.9. Right? So I'm kind of taking this data and sort of adjusting where I am. And all the data I look at just keeps pushing me closer and closer to the bear side. 2.9 is pretty bearish. It's not like sell everything bearish, but I don't like the Atlanta Fed sitting close to 0 because that's just going to get revised negative, just like what happened historically. I don't think this time is different. I like looking at history. And in prior recessions, we usually revise down into a recession. So that's why I lean more on the bear side, and I can't wait to be Mr. Buy the Dip again. But the thing is, it's I feel like I always lose because as soon as I turn bearish or as soon as I turn bullish again, everybody's gonna be so jaded about stocks. Like I think it was the Barclays this morning. They're like, oh, stocks sold off, so now they're reasonably valued, and I'm like, 5% off all-time highs now makes them reasonably valued? Okay. Let's agree to disagree for a moment that they're reasonably valued. How about this? I don't want to buy reasonably valued stocks. I want to buy undervalued stocks. I want to buy the cheapest, dirtiest stocks that you could buy at a massive discount. I want Restoration Hardware all over my face. I want Restoration Hardware. Why? Because I actually think it's going to fall even more. But they're trading for like a half peg right now. We did a full analysis on them. And I'm going to keep analyzing them. They're getting price cut like crazy by Wall Street analysts. Like Guggenheim cuts the price target. Great. The more these analysts cut the price targets, the happier I am. I cannot wait to buy Restoration Hardware stock at a discount. It already is at a huge discount, but I want even more. I want a bloody discount. That's what I want. It's kind of like what we do with House Hack. I want deals that are so nasty that nobody wants to buy them. And then we can get really fat wedges on them. Look at this. $171,000 of wedge value we made. Didn't pay a dime of taxes on it because we bought a house for $507,000 that's worth about $760,000 right now. And it looked like nasty. Who's going to live in that? No soul is going to live in this. It's disgusting. It's like rot and feces and nasty. It's disgusting. You know, and the House Hack comes along and makes it beautiful again. And just remodels and renovates everything. So we get paid money for that. And the more people invest in our 5% bond, which we just doubled the people investing in our bond over the last week, which is crazy. I think people are diversifying from the stock market. You can be a non-accredited investor now too. You get a 5% yield. You get upside. If our valuation goes up, you get 100% of the upside. You get 5% per year, and we buy, fix, build, and manage the real estate for you. And we do it in a transparent manner. All of the properties are listed. Like, that's our building. That's our house. Like, these are our properties. You can see them all over at househack.com. It's kind of cool. So I encourage you to check that out, househack.com. At least think about it. Like, people ask me, like, Kevin, well, you know, what's the deadline to invest? We're not trying to pressure anybody to invest right now. If it's good for you as a diversifier, do it. You know, that's your personal decision. Read all the information about it, the circulars and pre-PMs or whatever. But we see it as the sooner you invest, the sooner you A, diversify, and B, get a 5% yield, which is kind of cool because you get both. The upside of private equity stock, downside protection, and the yield. I think it's awesome. So, okay. So this gives me, this is sort of a bit of my thought on what's going on with tariffs and the economy and the bull-bear scale. I'm just not ready to get in there and say, oh, I want to buy everything. See, Barclays wrote, making sense of it all. U.S. equity markets are more reasonably valued after the pullback. Well, honestly, like, part of that is redundant, like, no duh. If something's at $100 and then it drops to $95, congratulations, Sherlock. It's more reasonably valued. Like, you didn't really tell us anything. So I feel like even Wall Street people are really, really confused. And I think that's why you're getting some of the risk shaving that we've seen, where you get this environment of, okay, we got a bit of a bounce again. Let's use that as an opportunity to take some risk off the table again. And this is a feature of recessionary environments, where you get these really volatile, oh, the worst is over, the correction's over, you know, buy the dip, and it all comes up. But then people are like, cool, that was fun, take my money now. So we'll see. But that's my take on tariffs, the Fed, and the economy this morning.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.